Welcome you to our YouTube channel PNJ Legal. We are 12-year-old law firm. On this YouTube channel, we are bringing lot of the complex legal topics to you. We are also presenting lot of business opportunities for the entrepreneurs to get ventured into.
This slide is the introductory slide. This slide reveals the topic of the presentation. This slide is about International Financial Reporting Standards. International Financial Reporting Standards, commonly called IFRS, are accounting standards issued by the IFRS Foundation and the International Accounting Standards Board (IASB). They constitute a standardized way of describing the company's financial performance so that company financial statements are understandable and comparable across international boundaries. This slide is the continuation of slide 2nd. IFRS has replaced many different national accounting standards around the world but have not replaced the separate accounting standards in the United States where US GAAP is applied. This slide is about the history of IFRS. The International Accounting Standards Committee (IASC) was established in June 1973 by accountancy bodies representing 10 countries. It is devised and published International Accounting Standards (IAS) interpretations and a conceptual framework. This slide is the continuation of slide 4. In 2001, the International Accounting Standards Board (IASB) replaced the IASC with a remit to bring about convergence between national accounting standards through the development of global accounting standards. In 2022, the European Union (EU) agreed that from 1 January 2005, International Financial Reporting Standards would apply for consolidating accounts of the EU-listed companies, bringing about the introduction of IFRS to many large entities. Other countries have since followed the lead of the EU. This slide is about the adoption of IFRS. IFRS standards are required in more than 140 jurisdictions and permitted in many parts of the world, including South Korea, Brazil, the European Union, India, Hong Kong, Australia, Malaysia, Pakistan, GCC countries, Russia, Chile, Philippines, South Africa, Singapore, and Turkey. This slide is the continuation of the slide 6. These are based on information from various resources. Due to the difficulty of maintaining up-to-date information in individual jurisdictions, 3 sources of information on current worldwide IFRS adoption are recommended: IFRS Foundation Profiles page, the World Bank, and International Federation of Accountants. This slide is the continuation of slide 7. Ray J. Ball described the expectations by the European Union and others that IFRS adoption worldwide would be beneficial to investors and other users of financial statements by reducing the cost of comparing investment opportunities and increasing the quality of information. Companies are also expected to benefit as investors will be more willing to provide financing. This slide is about US GAAP. US GAAP remains separate from IFRS. The Securities Exchange Committee (SEC) requires the use of US GAAP by domestic companies with listed securities and does not permit them to use IFRS. In 2002, IASB and the Financial Accounting Standards Board (FASB), the body supporting US GAAP, announced a program known as Norvik Agreement that aimed at eliminating differences between IFRS and US GAAP. This slide is about the conceptual framework for financial reporting. The conceptual framework serves as a tool for the IASB to develop standards. It does not override the requirements of individual IFRS. Some companies may use the framework as a reference for selecting their accounting policies in the absence of specific IFRS requirements. This slide is the continuation of the slide 10th. The objective of financial statements. Users base their expectations of returns of their assessment of the amount, timing, and uncertainty of future net cash inflows to the entity and management's stewardship of the entity's resources. This slide is the continuation of slide 11th. Qualitative characteristics of financial information. Conceptual framework for financial reporting defines the fundamental qualitative characteristics of financial information to be relevance and faithful representation. The framework also describes enhancing qualitative characteristics: comparability, verifiability, timeliness, and trustability. This slide is the continuation of slide 12. Elements of financial statements. Conceptual framework defines the elements of financial statements to be asset, liability, and equity. This slide is the continuation of slide 13. Income. Increases in economic benefit during an accounting period in the form of inflows or enhancement of assets or decrease of liabilities that result in increases in equity. Expenses. Decreases in assets or increase in liability which result in decrease in equity, and other changes in economic resources and claims, contributions from holders of equity and distribution to them. This slide is the continuation of slide 14. Recognition of elements of financial statements. An item is recognized in the financial statements when it is probable that future economic benefit will flow to or from the entity. The resource can be reliably measured. In some cases, specific standards add additional conditions before recognition is possible or prohibit recognition altogether. This slide is the continuation of slide 15. Whilst the standard on provisions, IAS 37, prohibits the recognition of a provision for contingent liabilities. This prohibition is not applicable to the accounting for contingent liabilities in a business combination. This slide is the continuation of slide 16. Concepts of capital and capital maintenance. Concepts of capital maintenance are important as only income earned in excess of amounts needed to maintain capital may be regarded as profit. The conceptual framework describes the following concepts of capital maintenance. Financial capital maintenance. Under this concept, a profit is earned only if financial amount of the net assets at the end of the period exceeds the financial amount of net assets at the beginning of the period. This slide is the continuation of slide 17, physical capital maintenance. Under this concept, a profit is earned only if the physical productive capacity of the entity at the end of the period. Most entities adopt a financial concept of capital maintenance. However, the conceptual framework does not prescribe any model of capital maintenance. Thank you.